Thank you so much for that. That was a mind-blowing panel. I really enjoyed it. It's crazy to hear the leaders of such globally important financial institutions talk about doing this work on public blockchains after all these years. Just mind-boggling to see the growth of the industry since they were talking about DLT just a little while ago. We've got an amazing panel coming up next. Is the current VC model in Web3 still sustainable? Please help me welcome to the stage Rob Hadick, General Partner, Dragonfly, Leeor Groen, Managing Director of Spartan, Danish Chaudhry, Co-founder and General Partner of Paper VC, Matthias Weissl, Co-founder and General Partner of WTG Ventures, and Xiao-Xiao J, Digital Operating Partner at KKR. Thank you so much for joining us at the stage, gentlemen. A round of applause, please.
All right, welcome. Really excited to be here. Quick intro about this round. We have an exciting panel coming up about the sustainability of Web3 VCs. My name is Xiao-Xiao. I'm an operating partner at KKR, 600 billion AUM, one of the largest private asset managers in the space. And we are also invested into crypto VCs, some of the leading investors here. Yeah, maybe a quick round of intros. Matthias?
Sounds good. Happy to be here and happy to be the smallest fish on this panel. Matthias, we are a venture firm out of Zurich, Switzerland, and we apply private equity principles in the space. 3 partners, prop capital only, and we focus on early stage, but also on late stage ventures, actually. And yeah, that's exactly what we're doing.
Hey guys, great to be here. I guess it's like smaller fish to biggest fish sort of thing. I'm Danish Chaudhry.
You have a nicer beard, though.
Thank you. I'm Danish Chaudhry, founding partner of Paper Ventures, pre-seed, seed stage fund. It's about 1.5 years old. We're very founder-focused, first check-in, and help founders from company formation all the way to cap table to take them to market to Series A and B sort of thing. So.
Hi everyone, my name is Leeor. I'm a managing director at Spartan Group. Spartan's based out of Asia with offices in Singapore and Hong Kong, and I have the privilege of working outside of those markets, covering Europe and North America. We started with a hedge fund, actually, so different approach to VC, and eventually went downstream to doing early stage venture. So today we run a liquid strategy as well as 2 venture funds, one focused on DeFi, one focused on gaming. Our model is similar from first check-in through to exit, covering the lifespan and life cycle of the best entrepreneurs in this space and working with the industry as and where needed. So great to be here and look forward to the discussion.
So I guess I'm the biggest fish, but my name is Rob Hadick, GP at a fund called Dragonfly. If you don't know us, we're about $4 billion under management, C through Series B, checks from $3 to $30 million. Glad to be here.
Great. I think it would be interesting to get a little bit into evaluation of the current state, but just to get us a lay of the land, right? The state of the crypto VC market, right? If you believe sort of the latest estimates, 2024, we had roughly 13 billion of VC crypto funding deployed, which is about a 30% increase from 2023, right? So good, but it's about 60-70% down from the peak in 2021, right? So that's where we are probably in this sort of life cycle. If you then look at the AUM, right? Total, we're looking at about probably 60-70 billion of AUM in crypto VCs. However, most of that was raised in 21, 22, right? 23, 24, and 25 was really difficult for a lot of crypto VCs to kind of raise to a similar sort of scale. But at the same time, if you compare the 70 billion, right, of AUM, it's actually quite different to TradFi, where in TradFi you have most of the AUM, right, institutional AUM goes into liquid hedge funds, right? And which is actually like about 80-20 compared to sort of VC or private equity in TradFi. In crypto, it's the reverse, right? So we have 80% of the total AUM, much smaller amount, probably like 10 to 20 billion only in directional or market neutral sort of liquid funds. So it's a very different picture, right? So that's sort of where we are in the sector. Now, my question is a little bit, as an investor, right? Whether you're institutional or a retail investor, you fundamentally, you want to have crypto exposure. You have 4 choices, right? You can go public tokens, buy Bitcoin. You can now go public equity, Circle. You can do private equity. You can even invest in Dragonfly, right? But you need to have a couple $1 million. Or you can do liquid funds, but that's also like high threshold. You need to be an accredited investor, etc. Maybe the first question is like, just to get us kicked off, what should be the role of crypto VC, right, in a portfolio of an investor, whether it's institutional, right? Like, do we have like a portfolio allocation theory? Like, what is the optimal allocation? Maybe we can start with the more sort of Danish and Matthias, because you guys are not, you guys have, prop capital as well, so you must think about these things as well. What's the optimal allocation?
I think, so I'm an LP in about 18 funds. With 2 of my partners, we're LPs in about 25 funds. And we've been LPing for the past like 5 years. And we have seen 0 DPI and 0 returns. You name it, whichever fund we're a part of. So I think the number one, if I'm looking at it as an institution into a venture fund, I think the number one thing I want to look at is like, are they returning money for investors? Is there DPI? Like, what's the MOIC? Like, am I going to see my money back? Because most of the funds, maybe I've picked the bad ones, but like, of the 18, none have returned any money or been any collaborative or like actually shared deal flow or any of that sort of thing. So I think as an LP, that's the number one criteria I would kind of have.
This is 21 vintage or 22 or 21, 22 vintage or
21 vintage, 22 vintage, yeah. 22 vintage was the worst actually. It's not return.
So maybe I'll add a little bit to that, right? In Web2 VC, we're 3 years into the 22 vintage, right? In Web2 VC, I would never have had an LP asking me, why don't you have DPI yet? DPI in 3 years is not common, right? If you look at the history of returns, you look at the math, the expectation is that DPI maybe starts around year 4 or 5, and that most of the returns come in the latter half of a 10-year fund life, right? And so there's this idea that like if you started a fund in 22, you should have DPI now, is completely related to the perverse incentives of early liquidity of tokens that have not allowed people to have a good perspective on where we're going in this industry and like how to actually invest for the long term. And so my general thought here is that like we tell the founders we're long-term investors. We have liquid tokens that are significantly marked up, that are worth hundreds of millions of dollars that we're not selling because it is still early in the life cycle of that protocol, of that business, and where they're trying to go. And as long as we still have a thesis on where they're trying to go, we should continue to invest alongside them like a venture partner and not a trader. And whereas a lot of these funds that I've been talking about being venture capital firms are really just trading firms in disguise and are kind of trading out of things that they don't have a thesis on really quickly. And that is not good for the space, and it's not the way that at least we try to partner with portfolio companies.
I think the scary number is not the 2021 vintage number, it's the 2017 vintage number. Only 25% of all funds have actually returned any DPI from 2017. And in 2017, you could literally invest in anything and you could make some money. That's the real scary thing. Another scary fact is that 70% of all investments go straight into infrastructure. And when we look at these infrastructure players launching a TGE, only, I think, 12% have actually more than 5,000 daily active users, which shows there's like 0 to no utility in the space, and there's like a significant trend right now that private liquidity deals that's where people make money. So a lot of VCs, they go to private liquidity deals. They provide capital 6 to 8 months. They will be the first one in, first one out as well. Basically 0 vesting. It's a liquid asset already. You lock in the valuation already, and if the valuation doesn't hit the threshold that you're arguing for, you get an extra on top. So, and then you have BTC treasury deals that are coming. So I think that's kind of an issue right now, that VCs need to even talk about BTC treasury deals.
Look, I think we're already jumping ahead, right? Going into sort of, I mean, the title of the panel is like, is this current model sustainable? But I guess for sure there is a role of top crypto VCs, right? Adding value to projects and founders, right? There's a reason why venture capital exists, right? They have a critical function. The question is a little bit like, are we oversized, right, in a crypto cycle? And where's the sort of natural, or what would we need to change for the sort of status quo to be more sustainable? But let's go maybe a little bit into the key challenges. You mentioned already a few of them. I would say, if you think about the key stakeholders, right, you have the investors, which are LPs, right? And the challenges there, from my side, obviously you heard DPI exit, but also the other challenge I think is we are inherently in a very liquid asset class, right? Like majority is the 3 trillion sort of market cap in the liquid public tokens. VC is tiny compared to that, but you're always comparing whatever you invest in VC against, well, I could have bought Bitcoin or Ethereum or Solana, right? Like, and I could have exited at any time and probably performed well in that short amount of time. So that sort of benchmark is a big question. DPI is the other question. Now, from a founder perspective, right, Rob, Leeor, like you deal every day with founders. While there was a super critical role in 21, 22, now there are emerging alternatives for successful founders to kind of like really scale companies. We have Hyperliquid. We have, obviously Pump.fun, kicked off the whole meme coin. Some founders go down that route to fundraise directly from retail. We have Echo, platforms like Echo, right, where you sort of crowdfunding, etc. And then the third stakeholder, probably retail markets, public markets, right? There's this increasing perception that VCs are sort of, or retail is being treated as exit liquidity, right, for VC backs, and that they're trying to a little bit play a different game by avoiding VC-backed tokens. Now, how do you sort of maybe can you just add to that before we sort of respond to what we could do to change?
Yeah, so let me just quickly weigh in here, I think, on the market structure and the dynamics that exist. And I think that this has been a very, especially for those of us who've been around in the space since 2017-18 with active pools of capital. I mean, we started as a hedge fund and an organization. As you mentioned, there are pseudo VCs, so trading firms that act like VCs. And for us, our DNA as an organization started as a liquid manager. In those early days, the first things that started happening were opportunities like Chainlink, Synthetics, MakerDAO. The original DeFi projects came out and said, we're going to do something differently, and we wanted to support them. But these things weren't liquid or trading in the same way, so we weren't able to actually participate in these opportunities in size and scale that we like, because you weren't hitting liquidity thresholds against your top assets, which is, again, a fundamentally different thing, which liquid managers have to deal with, which typical venture investors don't and shouldn't, for the reasons Rob pointed out, focus on, certainly not in the first 3 years. So the fact that we've shifted from being a liquid manager going to VC, and I think that is the structure of people today, is the VC in this industry is expected to do everything. You're expected to be able to provide TVL, which is, if you were looking at fintech players or like, let's say, other types of growth equity players, you'd be fulfilling the kind of private debt, venture debt functions of actually creating and providing capital pools in non-equity financing forms and dilutive forms. You're basically putting all of that into one single vehicle, which is incredibly difficult to manage, exactly for your point, Rob, because some of the token liquidity horizons are within 6 months to 6 years, whereas some of the equity horizons, as we all know, can take decades to build some of the long-term category-defining winners. Everyone is out here chasing those opportunities, but within a single pool of capital, it becomes very difficult. So VCs have had to become effectively some form of treasury managers in their own right, and the fact that you've taken the views that you have, that you're not selling anything, even if there is a liquid token, I think is very respectable and certainly something that stands out. But not everyone is in the position to be able to do that, just given the way in which their portfolios are constructed. So I think ultimately what it's coming to, though, just to round that out, is the current model has certainly evolved, because whether we chose to or not, if you're investing in this space, you have some belief in decentralized networks and ecosystems, that presents itself often in token forms as well. Not only there are equity opportunities, there are many of them, but there is a role that token ecosystems and networks and protocols are playing. And if you haven't been investing in that, you likely aren't here, still in the industry today, talking about being successful in this industry. And I think that that's where we need to be honest, that there is this inherent challenge that VCs are dealing with in terms of how do you put that into one vehicle and manage it.
Maybe I'll comment on one thing there, which is that it's not that we never sell. It's just that we don't see the liquidity event or the token going live as the time to sell, right? Like the time to sell is when the thesis has been realized, right? If you look at actually, Sequoia did some interesting data around this. They made a lot more money when they actually held, like if you looked at the returns of Square, for instance, like the returns of Square primarily happened after it was already public. If they had just decided to sell everything at the $3 billion IPO, like, would have been a good investment, but then it ran up to a $100 billion company, right? And we're starting to see this with tokens as well, where, things that are back from the dead, like Maple or Euler or others, like there is room for protocols to build product market fit and to build sustainable, long-lasting companies. And the perspective of a lot of crypto venture capitalists has been, okay, you launch a token, that's the product, I dump it on retail, and now we've all made money, and let's go be rich in Switzerland or somewhere, right? Like that is the problem that we have in the space, and why we have these things or this like retail Twitter phenomenon where people think VCs are the bad guys, because there's just so much short-termism in the space. Like if we try to self-regulate in a way that is saying like, listen, like we can have longer lockups, we can be more thoughtful about what those vesting schedules look like. We can maybe have milestone-based payments for teams and et cetera, right? Like now all of a sudden it becomes okay, like we're all aligned to building a better future, right, and protocols that make sense. And so our perspective, or at least my perspective, has been that things like Echo, Echo's great, right? Like it's, crowdfunding's been around since 1995 or a little bit earlier. It's been around for a long time. Like it's a good way to get, retail capital and do capital formation and as part of, the structure of private capital, but it's not going to replace venture. Venture still needs to exist. We just need to do a better job of defining like what is venture, what is liquid, what are we trying to get out of this pool of capital, and that opacity is more of the issue today and the lack of transparency than anything else.
So, yeah, I agree with Leeor that structures like between liquid and venture. I think more funds are now going towards liquid because venture returns aren't there. And like, as Rob kind of alluded to it, I think, in my personal opinion, the venture structure is completely broken, and it's changed over the last 2-3 years, where like, as a venture fund, I feel like I'm at the bottom of the stack. The founder sells their shares even before their token's launched, OTC it out, KOLs make the money, and as a venture fund, I'm expected to hold when there is no bid for my tokens in 3 years by the time I get unlocked, right? So I think over the last 2-3 years, bad actors have gotten rewarded. I think bad governance has happened. There is no board, there's no accountability for founders, and I think as a venture fund, we should be enforcing that. Like in Web 2, like a founder can't fart without the board knowing, basically. Whereas in Web 3, I know founders who've exited their bags before they've even listed on the exchange, sort of thing, right? So I think the structure needs to change, where as a venture fund, we need to enforce more accountability, more granular detail from the founders, and have them answer to questions and like work alongside us rather than like just exiting first.
Well, I think like this is a good point, right? Because it's a governance point, right? And like governance exists in a very like known and well-trodden way in Web 2 and in traditional equity companies, even in Web 3, but in traditional equity companies. Most of the reason there hasn't been board and like real governance today is one, because the VCs haven't wanted to actually like do the work. Like it takes time, right? Like I spend a lot of time on the boards that I sit on. But two, because there's a lot of regulatory concern around like how you might be sued if you're on a board and what the situation might look like in the US. That's changing now, right? And at least from my perspective is like it is up to us to do the work to make sure that there is real governance, so you don't have like move type situations where like everybody is trying to like sell before they're supposed to be able to. There's a lot of opacity, and it's essentially a Ponzi scheme, right? Like, and that is what happened in Move, because the venture capitalists didn't do the work, right? And so it is up to us to enforce the world we want to see, in my mind.
I think I agree with you, Rob, that a lot of VCs don't want to put in the work, but also I think we shouldn't forget a lot of these VCs are not VCs. They are random traders that trade on the back of the future of the founder and extracting value from retail. That's really what they do. They made a little bit of money in 17 and 21, had a few friends and family, gave them a little bit of cash. That's basically what, so 90% I would say of VCs right now, they call themselves VCs, do. And I think that's a huge problem because what happens, these are bad actors and they want, in order to raise a fund with having no DPI, they need to create artificial DPI. And how do you do this? You force a founder to spend all of his cash for vanity metrics so they get listed on a somewhat okayish exchange that gets enough volume so this VC can actually extract the money back out immediately. No wonder vesting periods have been cut down to 12 months. No wonder OTC deals, it's basically founder versus VC, OTC deals. Who is going to sell it first on second lane or some other exchanges. And no wonder exchanges, lawyers, service providers, agencies are the only ones that are actually benefiting. They all make a lot of money, and we are now at a point where there's no real utility in the space, or barely, and you have cases where really fundamental businesses are struggling, that create real revenue from the Web2 world, that are struggling to be listed on any proper exchange, even though they have a fundamental business model. But the net new users for the exchange might be better if they have a meme coin. I
mean, it sounds like there's a bit of a structural challenge. If you look at the numbers, right, there is a relative abundance of total venture capital markets, which drives the fact that founders just have an oversupply, probably, of like available venture funding, so they can just pick whoever has the weakest governance requirements, right, and get away with it. So is this sort of a reckoning for the industry, right? Like we see, like, venture capital, it's much harder to fundraise right now. Maybe it's a good thing, right? That means that the bad VCs just cannot fundraise and only the good ones can. But I doubt that the LPs are that sort of advanced to be able to fulfill that selection function that's required for the industry. But maybe let's move forward to the next step. Like, what, as leaders, right, leading investors in this space, what have you done or what are you planning to do to kind of like change some of this like unsustainable parts of the industry, right? Who wants to start? Yeah.
Sure, happy to take it briefly. So we take a complete different approach. We're not a fund, we're not a GPLP structure, we're a Swiss holding company because what Leeor said actually, you cannot fulfill all of these things, liquidity, TVL, all of this. And we are 3 founders. We have exited multiple companies, we've crashed multiple companies, we've gone bankrupt together 10 years ago, all of this. And I think we have founder empathy. We know, we bring the DNA, and thankfully we have 3 partners where one is really built cryptography solution for NATO frontline soldiers, another one's designed cities in Asia, and so on. So we have really 3 different perspectives. And we realize how difficult it is to found. We see first-time founders, what do they want? They want cash. Nothing else, shut up, leave me alone. Second-time founders, what do they want? They really want to be picky. They want to like, okay, who's the right sparring partner for me? And I also need you to provide TVL and so on. So what we did, we became a venture partner in another fund where we can provide up to 30 million in TVL on top. We also became a venture partner in a fund with the largest Ethereum validator. We can provide 30,000 nodes with the investment. And we are very hands-on, and that's why we call ourselves private equity for permissionless tech. This has nothing to do with leveraged buyouts, has nothing to do with control. Forget everything you've learned about PE. All it is, it means founder DNA, it means real unit economics. Like, how many founders do I ask, okay, how much money do you make per TVL, or how much money do you make per volume, and they don't know. It's really scary. They all think, last round was at 60, next round's at 120. Well, I don't care what valuation. I need to know what your unit economics and growth are. And I'm really surprised how founders, the lack of understanding of founders are. So basically what we tell ourselves, we put KPIs to ourselves. We need to be able to support founders in critical inflection points, and that can be liquidity, launch, listing, and growth. These are the 4 points founders are struggling daily, and that's why we work with founders on a daily basis, no excuses. Every day we speak to our founders, and we try to really make their lives easier and focus on the product. So that's why we are focusing more on the PE side and providing additional TVL, providing additional infrastructure, and so on. I think that was at least our only way of getting into these rounds as a small fish. You know, like a Dragonfly, a Paradigm, an A16Z, and so on. Ideally, they come after us. But yeah, that's our only way how to get in there.
Can I address a point that you made earlier, just very quickly? The average rate of return, or the median rate of return in Web2 venture is 17%, an IRR, right? Like, people in venture, whether it's crypto or not, this is not specific to us, like, they're not making good returns at a medium level, right? The best, all the returns are basically in the top quartile. Right? That's true, I think, in crypto venture. It's definitely true in Web2 venture. We have the data that shows that. And we've started to see a right sizing of funds. If you look at the amount of capital raised from LPGP capital last year, like 85% of it went into only funds over $500 million in Web2. And then there's a few like niche emerging managers who are able to raise capital as well. We're seeing essentially a hollowing out of the quote unquote middle class of venture. That is not a crypto specific point. It is a point that's happening across all of venture. Because there has been too much capital into private venture capital broadly. And that's true in crypto, and it's true of non-crypto. And so, like, I do actually think the LPs are sophisticated enough, and you don't give yourself enough credit, Xiao-Xiao, to be able to figure out, like, who is good and who's not. Like, where am I supposed to be putting my capital? Because they understand this perspective, and this is why this is happening. And so, I think the fact that, like, you know, there's no longer $2.5 billion, you know, Paradigm raised a $2.5 billion fund in 21. Great fund. They raised 850 last year, right? Like, this right sizing is happening across the whole industry. The amount of funds that I've seen who raised, you know, $300, $400, $500, $600 million in 21 and 22, who are raising 200 today or 100 today or struggling to raise, it's endemic. There's so many of them happening, and that is a good thing. That right sizing is happening, and I think the LPs are causing that, right? I think then to your point, well, like, how do we solve some of these structural problems? Well, like, again, it is up to us. Like, for us, like, you know, we've taken the perspective that we don't co-invest with certain people. There's certain people on the cap table that we think are people who try to formulate or facilitate pump and dumps. We won't invest in them. And we have a list of people that we think try to do that, right? We are a lot more thoughtful around governance than some people are. And, like, we don't negotiate on that. If they want to, if a founder wants to pick another fund because they have light governance and won't pick us because we have actual governance, well, like, that's not a founder that I want to back, right? And that is fine, right? And so I think there's just we just have to understand that the market is going to only change if we change it, right? And then we have to collectively work together as good actors to be able to do that. We've been talking to, you know, one of the things that I think is a problem in the space right now is there's not really a disclosure regime. And so I've had a lot of discussions over the last couple of months with exchanges and with other venture capitalists alike on, like, trying to put together a disclosure regime, because I don't think the government is going to do it for us, right? I don't think the SEC and the CFTC are going to do that. And so how can we help push that forward? And that's the only way it changes in the near term, in my mind.
Maybe specifically to the point, right? How do we prevent these kind of, like, founder OTC or, like, treasury, like, outs? Like, I mean, you're one of the leading investors in the space. How do you address something like that? Like, when you do DD, you may not know, right, that these kind of things happen, and then founders are incentivized. They're offered some of these deals. Like, how do you prevent that?
I mean, I'll let these guys talk too, but like it is in the documentation that they cannot sell unless we are also selling, right? Like, if they do that, it is illegal, like, and we can sue them, right?
You sue them.
Yeah, I mean, we haven't, and God forbid we won't, and hopefully we partner with the right with the right entrepreneurs that, like, it doesn't get to that, and we try very hard to do deep diligence on, you know, the people that we're partnering with. But, like, there is actual governance involved, that there is legal ramifications if they were to do that.
So, sorry. To Rob's point, I think, like, we're pre-seed seed, right? So sometimes we will just be co-investing alongside others. We're not at the level where we're lead or co-lead. And in that stage where a venture fund leads or co-leads, doesn't put governance in place, we're just along for the ride, sort of thing. And that way we're kind of screwed because, you know, one middle tier fund didn't put in governance, so now the founder's running amok doing their OTC sort of thing. And part of it's like a self-fulfilling, like, cycle where founders will only go to funds that will give them zero governance. And that fund will then, in turn, only fund founders that will help them exit and leave, sort of thing. So I think there's like that cycle needs to be broken, because sometimes they get all the deal flow, and like if you call them out, you are shunned. Like for example, in the case of Movement, everybody knew crime was happening, like day one. Like all the funds on the cap table knew crime was happening, but nobody called it out. Because the moment you called it out, they'd be like, okay, don't send them deal flow and don't talk to them and that sort of thing. So that needs to be a little bit broken. But like, you know, as the guy said, both Rob and Matthias is like, when we lead and we co-lead, we put it into terms that like, I need a monthly report. We're so early stage that we also help with the recruitment, so we know all the salaries that are getting paid. We know all the token allocations that are given, what the vesting is, and all that sort of stuff. So like, yeah, like that governance, I guess it needs, because more funds need to kind of see it the same way that we do. But like, there's a lot that are out there that just want to make a quick buck and fuck off, basically, sort of thing.
So I think the conversation's taking a little bit more of a founder-verse VC approach here. And I don't think that that's, I want to call that out and say that's certainly not how we think about it. The honest truth is, if you're having concerns about founders exiting OTC deals in a company, you as a VC have failed in your diligence process, assuming that we're all doing the things that we're saying here on the stage, which is backing entrepreneurs to make a real difference and not just make money quickly. So I do think that that is a foundational quality that perhaps hasn't existed in the past. I think we can all acknowledge it hasn't happened, movement, a lot of things, and when you're in the middle of something, it's difficult to call it out as and when it's happening. But the basic principle that founders are selling against VCs in OTC deals in advance, that's a reflection on you, because when you as a VC are coming to the table, we are far less risk on than most of the founders are, right? I mean, we have eggs in multiple baskets, we construct portfolios, they build companies. It's a very different risk profile. What they're engaging in is a multi-year, often at least should be, multi-year commitment to build and scale a project, protocol, business, whatever it is that they're going after to make a meaningful development in the industry. And if it wasn't an exciting idea or big enough opportunity, it wouldn't be venture capital backable. And if it wasn't someone that you would trust to deliver that return and value back to investors as well as to themselves and to the community, and we all understand how important community is in Web3. It's a foundational piece and tenet of what drives success in this industry. If that doesn't exist and you don't have the belief that those founders are going to do that with integrity, I think that that's really a reflection on us, and to be honest, is where the industry has come from. Going forward, going to be very different. It already has been. Raising capital's become harder. VCs, there's less bad actors. There's less VCs out there with big checkbooks to deploy into God knows what. And now I think we're really at this point where there's an alignment and meeting of the minds between founders, and it's a win-win relationship. It cannot be us against them, and that will never succeed.
Fully agree. Now, coming back a little bit at, as an investor, an LP in crypto VCs, obviously we're in there to return money, create like financial return, right? And some of the tension, obviously, and I fully understand that, we're obviously also one of the biggest private investors in the world, so we're dealing with similar things on a day-to-day basis, but obviously much later stage. Let's talk about exit strategy, right? Like, because you're all in the business of returning money to your stakeholder. Like, even if you manage your own capital, but you still like have a duty to yourself to kind of like multiply that, right? Now you have that inherent tension, right? As Rob mentioned, we are in an industry in Web3 which is inherently super volatile. It goes up and down all the time. When it goes up, right, you don't know if it keeps going up or it will go down, right? So you have that fundamental choice at any time, right? Like, do you believe in your thesis that you had 3 years ago and just hold it, hope for the best? Or do you de-risk and hedge and take some money off the table, OTC, follow-on rounds? How do you deal with that, right? And then second question, target returns, but like, it's interlinked, right? Like, whatever is your goal, like, are you trying to hit an IRR target? Are you trying to hit a multiple money target? Actually, probably impacts your choice, right, when you're faced with that selection problem. Maybe, Rob, let's start there. We have that conversation from time to time.
No.
But
I'll try to be quick. But listen, if you're trying to hit an IRR target or a multiple target on a single investment, like, it's not going to be good for the portfolio, right? Because the reality is in venture, and it's a little less true in crypto, but like, it is a power law game. Like, your best the best investments.
Venture, not private equity. It
it's
actually
different
is,
in private equity, but in venture, like your best investments, they return the fund, and then you have a bunch of stuff that doesn't do particularly well. And like, so you have to be more thoughtful around, okay, well, like what is the thesis? Am I still constructive about where this business or this protocol is going? Do I think it's extremely overvalued, or do I think like they're going to continue to execute? And so for us, it's about a thesis specifically around that business, that protocol, and less around like a price target, because that is not like, one, fundamental analysis in crypto doesn't really work, and two, like that's just not what we are supposed to be good at, and we're not, price targets just don't really make a lot of sense. And so when something is liquid and it trades up, and we think that it's fulfilled the underwriting that we had, the thesis that we had, and we see it as like a mature company or a mature protocol, we'll monetize, and we do that all the time. We'll monetize in a way that we think is more appropriate or doesn't harm the protocol, and so sometimes there's low liquidity when we don't want to jam a market and kill a price. But that's how we decide to do it. I mean, and Xiao-Xiao, as you know, right, like 35% of our portfolio is equity. We've also started to see a significant amount of equity exits recently. So we've sold 3 companies in the first quarter that we had relatively good returns on, and one really good returns on. And we're starting to see a lot of interest there as well. And so I think, from my perspective, it's all about re-underwriting that investment every week, every month, and making sure that like you still have a thesis. And if you don't, that's when you know it's time to get out.
I just weigh in on this because I think it's an important distinction of what is the role of good venture investors, and to Rob's point, re-underwriting theses is important. But let's take 2 of the most concrete examples that come to mind just based on what we've seen. Circle, which has just IPO'd, talk of the town, obviously, and glad to be on that journey. Circle was not a stablecoin company 5 years ago, right? Circle had raised hundreds of millions of dollars, had competed as an exchange, had acquired Poloniex, had done so many things over the years and reinvented itself so many times to get to a point where its capital markets debut in 2025 is as successful as it has been. That is incredible, and that shows you a lot of the resilience under the scene. But we were not underwriting that investment in the series A, B, C, Ds of that company's growth cycle. And you could say maybe that's the equity story. DeFi is different, on-chain activity is different because people have a clearer focus. Potentially, if you were to tell us, and we led the Solana private public sale back 2019, 2020, took them to market, helped with that, and Multicoin was the biggest investor. Regret we weren't a bigger part of that, but ultimately, if you told me today in 2025 DeFi was going to live on Solana, no one knew what DeFi was. They certainly weren't calling it DeFi, and that framework and understanding of where transactions were happening, what was living where, didn't even exist, which takes you back to the concept of what is the role of a VC? How is that different from PE and strategies there, where you're buying operating companies, achieving scale either through revenue growth or cost synergies? In VC, it's a fundamentally different business model. It's a fundamentally different product, which is working with and supporting the best founders and entrepreneurs to do, be resilient, adapt, and capture opportunities in the market, which is why, if they're selling against you in OTC deals, probably not the right founders to be backing in the first place. Always easier in hindsight, but the concept is people are adapting to the market opportunity, and it's the long-term winners that present themselves when they've shown they've been able to reinvent and capture opportunities and continue to dominate and own a vertical. And I think that's what separates the top end of town from everything in between.
Yeah, I think to your question, I don't think selling your tokens and monetizing your investment doesn't mean that you do not believe in your thesis, right? I think you straddle both in the sense that we monetize in a constructive way, talk to the founder and say, hey, market's up, it's 5x, 4x, whatever. We'll work with market makers so that it's not destroying your token. But that's why we pay the premium in the beginning, right? That's why we wait for so long. That's why, obviously it's shorter in Web3, but that's why we pay the premium to monetize it, sort of thing. But also, I've been in the game since 2010, 2011. I still speak to founders that I funded in 2016, 2017, even though I'm completely out of the token, for example, right? So selling and making a return doesn't mean that you abandon the project completely. I'm still helping founders on their 3rd project or 4th project that I've known for 10 years, sort of thing. So I think you can straddle both, but obviously doing it in more of a constructive and helpful kind of way.
Yeah, and I think from our side, we're looking at it completely different because obviously we have a different structure, no GPLP structure. We're looking very, very long term. And we need to have a sustainable model because there's no management fee, there's no performance fee, there's nothing. So basically, the way we structure it is basically time, money, and value add. Time, we believe the best investors over the history have been the one that didn't invest for very, very long periods, but then really doubled and tripled down when it mattered. So we never wanted to have a dependency on time. Oh, we got to deploy now. Oh, we got to do this now. So we want to decouple ourselves on time. Money, we want to decouple ourselves from external money sources, obviously for multiple reasons. Because also, let's say you have a closed fund and you need to deploy. And the third one is value add. Our goal is we never want to compromise on value add because our fund closes and we got to sell at times when it might not be the best time for founders. So those are kind of like the three things that we're looking at. We don't do OTC deals. It's just not really what we're interested in. And we need to look very, very long term. And it needs to be a sustainable model. So when we create DPI, we put that into a hedge fund that creates monthly. So we're LPs in hedge funds, and they return monthly capital to us to make our entire model sustainable. That's our internal goal.
All right, we're closing statements. I would like to spice it up a little bit, and so I'm asking for a closing statement from each of you about something that you believe others on this panel might disagree with, but you have high conviction in related to crypto investing. Who wants to start?
All right, I guess I have to start. All right, I would say in the next 2 years, 90% of all venture capital firms will be bankrupt or will no longer deploy capital.
It's a shame. I kind of agree with that.
Go.
No, I think like on this panel we mostly agree with everything. I think from a specifically from a fundraising perspective, we're about to launch fund number 2. I think most VCs that I speak to think that if they've performed well on a $25 million fund, they're going to return the same on a $100 million fund. And this is like more like a fallacy, I think, in most VCs that if you return well in a smaller fund, you're going to do the same DPI or MOIC or whatever it is in a bigger fund. And it's mostly never the case.
Yeah, nothing else revolutionary to add here. I think we're in too much of agreement, but the industry will fundamentally change. The market participants will be consolidated, and yeah, I think the idea of multi-billion-dollar venture funds, while possible in aggregate on single vintages, I think we'll see decline of, and the way in which people partner with ecosystems. You'll be able to build companies, AI-backed companies, enabled companies, will have 8 to 10 people managing trillions of dollars of TVL, and you don't need hundreds of millions of dollars of VC backing to scale operations. The industry is going to be completely transformed, and crypto is where it's going to happen first, and I'm incredibly excited about that.
Yeah, maybe we all agree with this point, but I think like Web3 VC is just going to look a lot more like Web2 VC in 5 years, and like people who hold for the long run, that are thoughtful about governance, that are going to try to figure out how to build sustainable businesses and protocols. Like eventually they are going to win. Like we have been rewarding bad actors because of the early liquidity and the regulatory arbitrage that has existed. That is going away, and like this whole market is just going to change completely.
All right, I believe we are at time. Thanks all for your insights and discussion, and yeah.
Thank you.